Most people think of the dollar as just another currency, but in reality, it is the world's checkout lane. Every big deal passes through it, and nearly 9 out of 10 currency trades use it. Now, China is not trying to topple this system overnight. Instead, it is quietly building backup routes, step by step, to touch the dollar less and sidestep its reach. If these dollar avoidance moves keep gaining traction, what happens to America's sanctions power? And what could a more fragmented global marketplace mean for everyone else? To answer that, we first need to see why the dollar's deep pool of liquidity still shapes the rules of the game. Nearly every global trade deal, from oil shipments to electronics, runs through the dollar. The numbers tell the story. About 54% of all export invoices worldwide are written in dollars, even when neither the buyer nor the seller is American. Central banks hold around 56% of their foreign reserves in dollars, far ahead of the euro's 20%. And in the world's currency markets, the place where trillions are swapped each day, the dollar is on one side of almost 88% of all trades. This dominance isn't just about habit or tradition, it's about trust, scale, and something called liquidity. Liquidity, in plain terms, means how easy it is to buy or sell something without moving the price against yourself. Imagine a swimming pool. The dollar is the deep end, where you can jump in with a huge trade and barely make a splash. The euro and yen are the middle lanes, deep enough for most moves but not all. The renminbi, the Chinese yuan, is still in the shallow end. Big players stick to the deep end because they know they can get in and out without causing waves. This deep pool effect explains why the dollar is more than just a currency. It's the world's main invoice, the reserve of choice, and the safety net in a crisis. When markets panic, everyone runs to the dollar because it's the only place with enough depth to absorb the flood. That's why, even as new payment systems and currencies appear, the dollar's scale and liquidity keep it at the center of global finance. The next question is what happens when this pool becomes the switch for sanctions power? Sanctions work like a switch. When the US and its allies want to apply pressure, they do not need warships or blockades. They just flip the financial switch off. In early 2022, after Russia invaded Ukraine, that switch was thrown. The US Treasury, the European Union, and others froze about $300 billion of Russia's central bank reserves. Major Russian banks were cut off from SWIFT, the main messaging system for global payments. Headlines summed it up: US freezes $300 billion of Russian central bank assets. Within days, Russian companies and banks found themselves locked out of the world's dollar plumbing. Payments stalled, reserves sat untouchable in New York and Frankfurt, and everyday trade, from oil sales to machinery imports, ran into brick walls. Some workarounds emerged, but the scale of disruption was immediate. According to reported figures, more than 80% of Russia's external payment volume was affected as banks scrambled to reroute through less liquid channels. Even with new pipelines to Asia, Russia's non-dollar trade share rose only about 10 percentage points in a year. The dollar's role as the global checkout lane meant that if your payment touched a US bank, it could be stopped cold. That's the real-world power behind the numbers, a currency that is not just a medium of exchange, but an on-off switch for entire economies. For countries watching these receipts roll in, the message was clear. As long as your trade runs through the dollar, someone else holds the switch. CIPS, China's cross-border interbank payment system, was launched in 2015 to let banks settle international trade in yuan, sidestepping the dollar's traditional routes. By the end of 2024, CIPS had processed 175 trillion yuan, about $24 trillion, a 43% increase from the previous year. The network now includes over 1,500 participating institutions, with 73% in Asia and 17% in Europe. By early 2026, direct members reached 193, spanning nearly 190 countries and regions. Yet the map reveals a clear pattern. Activity is concentrated in Asia, reflecting China's strongest trade ties. Globally, CIPS still accounts for just 3% of SWIFT's total payment traffic as of mid-2025. Most international banks stick with the familiar dollar rails, reinforced by habit and the network effect. Even within CIPS, about 80% of transactions still use SWIFT messaging for final settlement. For China, every payment routed through CIPS reduces exposure to US-controlled switches. Still, its reach remains dense in Asia and thin elsewhere. The Shanghai International Energy Exchange has become China's main tool for testing how far it can push the dollar out of energy trade. Since its launch, the INE's renminbi-denominated crude oil futures have handled a reported 287.8 trillion yuan in cumulative turnover, about $41 trillion. That's not just paper trading. In 2023, over 40,000 contracts resulted in physical delivery, equal to roughly 4 million barrels of oil. Middle Eastern exporters, including some of China's largest suppliers, have delivered up to 5 million barrels in a single month through the platform. Foreign institutions can participate directly, provided they meet minimum cash requirements, and the contract's price closely tracks established benchmarks like Brent and WTI, with a reported correlation of over 0.9. Yet, the reach of renminbi settlement in global energy remains limited. LNG spot contracts settled in yuan have appeared in press reports, but volumes are small and most exporters still prefer the dollar, partly because their own currencies are pegged to it. Bloomberg notes that even as China resumes spot LNG purchases in 2025 to take advantage of lower prices, renminbi settlement in this market remains an early-stage experiment. The INE's crude futures offer a pricing tool that cuts dollar ties for a portion of China's imports. But for now, the deep liquidity that draws global players to the dollar pool is still missing from these renminbi markets. Most hedging in energy trade still happens in dollars, and the scale of physical delivery through the INE is modest when compared to the global oil trade. The experiment is underway, but the dollar's grip on energy pricing and risk management remains strong. China's strategy stretches from digital platforms to the docks themselves. COSCO, the state shipping giant, now holds stakes in over 100 ports worldwide, including Piraeus and Chancay. These terminals handle about 10 to 12% of global container traffic, with throughput at Chinese-controlled sites rising 5 to 7% each year since 2022. Control of these ports means more than just moving cargo. It is about shaping trade flows, bundling logistics, and quietly introducing renminbi-based settlements into the shipping business. Alongside these moves, China has built a gold reserve of roughly 2,000 metric tons, about 10% of all state-held gold, providing a buffer if dollar channels ever freeze. The country's managers have also reduced U.S. Treasury holdings to around $850 billion by late 2024, shifting reserves into gold and euro bonds. Each step, ports, gold, and careful U.S. Treasury roll-off adds redundancy and leverage, but stops short of a full break. These assets build options, not escape routes, as the next challenge looms. Shifts in global currency flows rarely show up overnight. Most big trade deals, especially in energy and raw materials, are locked in with contracts that last years, not months. When a Chinese importer signs for a year's worth of oil or copper, the price, payment currency, and even the risk coverage are set long before delivery. The same goes for the hedges companies use to manage price swings. These financial shields, often stretching 12, 24, even 36 months, are overwhelmingly written in dollars, because that is where the deepest markets are. Even when a new deal is signed in yuan, the old dollar contracts keep running in the background. Inventory buffers add another layer, letting companies ride out short-term shocks without changing their payment routines. All this creates a kind of procedural inertia. The machinery of global trade keeps humming along old tracks, hiding the early impact of any currency switch. That is why, for the average business or investor, the move away from the dollar feels more like a rumor than a reality, at least until those contracts and hedges finally roll off. Three main breaks slow any exit from the dollar. First, liquidity lock-in. The dollar's deep pool is hard to replicate. Even with CIPS and renminbi oil contracts gaining ground, the global anchor weight of the yuan sits at about 6% according to BOFIT. Most players still prefer to swim where trades clear fast and prices don't jump. Second, capital controls. The People's Bank of China sets strict quotas. Offshore renminbi can't freely move in or out, and the quota remains around 2% of China's foreign reserves. This limits how much foreign companies and banks are willing to hold or use the currency. Third, political risk premium. Every time tensions flare, the cost of using renminbi rises for outsiders, and most exporters still hedge their bets in dollars. Looking out to 2028, three scenario lanes appear. First, slow and steady growth, where renminbi trade inches up but stays regionally focused. Second, a crisis-driven surge, if sanctions or shocks force sudden adoption, though liquidity gaps would still bite. Third, stagnation, if network effects and controls keep the dollar firmly in charge. The key cues to watch are CIPS network expansion, offshore renminbi quotas, and any shift in how exporters price risk. The machine runs, but its gears are still set by the dollar's depth, China's controls, and the world's appetite for risk. Today, the dollar still runs the global checkout lane, even as China quietly builds its own plumbing. These experiments won't dethrone the dollar overnight. Every backup route adds leverage when tensions rise. The real question now isn't whether the dollar ends, but how much workarounds will matter when pressure hits.